Welcome to vTalkInsight, Market Drivers Daily for May 5th, 2026. Oil flows through the Gulf are under threat, AI investment is exploding, and long bond yields are breaking higher, all at the same time. Let's unpack how this combination of energy shock, technology buildout, and renewed tightening risk is reshaping the cross-asset landscape. The central macro anchor right now is the standoff around the Strait of Hormuz, which is turning an oil shock into a broader stagflation risk, especially for Europe and energy-dependent Asia. Missile and drone attacks on vessels and oil infrastructure have already forced a halt or diversion of traffic through key choke points, and roughly half of local shipping has shifted closer to Dubai as captains look for safer routes. Despite sporadic diplomatic outreach, the United States and Iran remain dug in, with neither side willing to relax blockades or fully secure the corridor. Recent U.S. naval escorts show that some oil can still move through the strait, and a fragile ceasefire technically remains in place. But repeated attacks on vessels and United Arab Emirates infrastructure keep risk premia high. Iran is shipping only a fraction of its pre-war oil volumes, leaving a sizable hole in its budget. Yet the regime appears willing to absorb domestic pain rather than compromise quickly, which prolongs uncertainty for global energy flows. On the pricing side, Brent crude is holding above $113 and New York crude above $104, while futures in a year-end are edging toward $100, signaling that markets now assign a meaningful probability to lasting disruption. More granularly, inventories in products such as naphtha, jet fuel, and LPG are thinning. Global jet fuel exports have fallen from about 2 million barrels per day to 1.3 million, and European kerosene shortages are already forcing flight cancellations and surcharges. U.S. refiners are ramping exports of jet and diesel to Europe, Africa, and Asia, which supports global supply, but also risks pushing domestic fuel prices higher and feeding back into U.S. inflation. This tightening in fuels is feeding directly into macro and sector performance. Energy stocks are leading in Europe, while travel and leisure names are under pressure as higher fuel costs squeeze margins and demand destruction becomes a live concern. European equities outside tech look vulnerable as high energy costs collide with already weak industrial activity and simmering U.S. EU trade frictions over autos, steel, and even French wine, where both sides are signaling a readiness to use defensive tariffs. In FX, the dollar remains the primary geopolitical hedge, with investors reluctant to run large short positions. But the usual link between U.S. rate moves and the currency has weakened since the conflict escalated, while ECB tightening is being interpreted as a growth negative rather than a euro positive. There are, however, reasons why crude is not yet at full crisis levels. The ceasefire, while fragile, is holding for now. U.S.-led escorts are managing some convoy traffic, and traders have been cautious about building oversized long positions, helped by active job owning for policymakers. Futures below $100 for prompt delivery still embed some expectation that flows will improve, and oil demand forecasts now contemplate a small contraction in 2026 as high prices, flight cancellations, and policy measures curb consumption. The counter risk is clear. If the standoff around Hormuz persists or worsens, several scenarios point to crude spiking toward $180 over the summer, with deep recession risks for Europe and Asia and further pressure on already fragile emerging market credits. Key watch points now are concrete progress on securing Gulf shipping lanes, evidence of further product shortages in aviation and transport, and any escalation in U.S., EU, or U.S. China trade and sanctions that could turn an energy shock into a broader fragmentation shock. Running alongside the energy shock is an AI-driven investment boom that is increasingly central to the global growth narrative. Recent days have highlighted just how large this build-out may be, with one major rating agency projecting more than $3 trillion of data center investment over the next 5 years, driven by hyperscalers and AI workloads. That scale makes AI one of the biggest infrastructure cycles in recent history, and it is becoming a core offset to the drag from higher energy costs, particularly in the United States. Capital markets are already financing this wave. Alphabet is returning to the euro bond market with a multi-billion euro deal explicitly linked to AI development, while Meta is planning a $10 to $13 billion data center in El Paso and is expected to see strong demand for associated debt issuance. Hyperscaler backlog growth has jumped from roughly 20% to more than 140% year-over-year in the latest quarter, and recent quarters show cash returns on AI infrastructure investment near 29%, encouraging continued aggressive capex. Analysts note that last year the market underestimated both AI leaders' capex and revenue growth, suggesting consensus forecasts may still be catching up with the pace of adoption. On the equity side, this is producing clear winners and losers. AI infrastructure companies are seeing accelerating demand and widening gaps versus laggards, while firms like Palantir report more than doubling growth in their U.S. commercial business as clients see tangible value from AI deployment. Pinterest shares are surging after better-than-expected results and guidance tied to stronger ad monetization and early AI initiatives, underscoring how quickly the market rewards credible AI revenue stories. At the same time, companies such as Coinbase and other tech names are citing AI as a reason to cut staff, blurring the line between genuine productivity gains and cost-cutting, and raising questions about how smoothly the labor market will absorb these shifts. In the near term, this AI cycle looks inflationary rather than disinflationary. Large-scale data center capex is arriving on top of high energy prices and expansive fiscal policy, adding to concerns about how long inflation will stay above central bank targets. Regulation is also moving to the forefront. The U.S. administration is considering stricter oversight, including pre-release national security reviews and vetting of AI models, while the European Union is working with firms like Anthropic to test for cybersecurity vulnerabilities. There is a growing risk that complex rulebooks may entrench current leaders by favoring firms that can absorb compliance costs, while politicization of AI debates or foreign influence efforts could tilt regulation in ways that slow innovation or raise barriers for new entrants. From a macro perspective, structural productivity gains from AI adoption are one argument for why U.S. real rates may be closer to fair value than in Europe, and why U.S. growth has so far absorbed the oil shock better than feared. However, even optimists acknowledge a lag between micro-level adoption and macro-level disinflation, suggesting inflation could stay elevated for several years before AI efficiency gains are fully reflected in price indices. Importantly, strong AI-driven earnings momentum now sits alongside an assumption of eventual geopolitical normalization. Several observers highlight that if Middle East tensions were to escalate further, the current concentration of equity leadership in AI beneficiaries could be forced into a sharp repricing. Looking ahead, the critical signals will be corporate capex guidance, credit market appetite for large tech bond deals, concrete steps on U.S. and EU AI regulation, and any evidence that AI-related layoffs are beginning to show up more visibly in labor and wage data. The energy shock and AI capex surge feed directly into today's rate story, where the higher-for-longer narrative we have been tracking is hardening into price action. U.S. Treasury yields are back near multi-decade highs, with the 10-year around 4.44% and the 30-year above 5%, levels not seen for many years, and signaling a deep repricing of long-duration assets. Bond volatility at the long end remains elevated, and the 5% level on 30-year Treasuries, once seen as a magnet for long-term buyers, is now being tested by persistent inflation concerns. Several forces are pushing yields up simultaneously. On the supply side, U.S. bond issuance is surging, with one estimate putting quarterly issuance near $189 billion, well above earlier projections, while the Treasury's refunding plans signal continued heavy use of Treasury bills, keeping pressure on short-dated rates. On the inflation side, crude above $100 and product shortages are expected to push U.S. headline inflation above 4% by May or June, with some forecasts pointing to a peak near 4.5% in the second quarter before easing toward the mid-threes as gasoline prices moderate. Survey data, like the ISM Services Prices Paid Index, sitting in the low 70s, reinforce the message of sticky input costs that make an early pivot to rate cuts harder to justify. Markets are repricing central bank paths in response. The probability of a Federal Reserve hike by June is now close to fully priced, and expectations for U.S. rate cuts are being pushed further into the future, with some forecasts assigning a high chance of another hike by April 2027. In Europe, markets are aggressively pricing further European Central Bank and Bank of England hikes, helping to drive UK gilt yields to levels last seen in the late 1990s and boosting sterling, which has outperformed other G10 currencies as investors swing from expecting cuts to anticipating multiple hikes. The Reserve Bank of Australia has delivered a third consecutive hike, taking its policy rate to about 4.35% and signaling a restrictive stance, although the subsequent pullback in the Australian dollar after initial gains suggests investors see limited additional tightening. At the same time, there's a growing debate about whether markets are now overshooting on the hawkish side. Some analysts argue that pricing for ECB and Fed hikes is excessive given signs of softening labor markets and still anchored medium-term inflation expectations, particularly in the United States. Fed officials acknowledge that Middle East risks and mixed employment data complicate the outlook, but still describe current policy as broadly appropriate. While in Europe, internal divisions and weak growth indicators mean a widely expected June ECB hike could prove a closer decision than futures imply. Macro projections suggest U.S. growth could slow to around 1% in the second quarter as high gasoline prices weigh on consumption before recovering later in the year, and AI-driven productivity gains are expected to become more clearly disinflationary over time, though not fast enough to ease near-term pressure. These dynamics are already visible across assets. The U.S. housing market shows only a modest bounce, with new home sales up 7.4% month-on-month, but still subdued versus pre-crisis levels under the weight of high mortgage rates. Across Europe, oil-importing economies face a tougher mix of higher inflation and slower growth, which weighs on their currencies even as rate expectations rise, and some investors see pockets of value in mid-maturity sovereign bonds, particularly in the 5-year area, relative to more pressured long ends. Earlier in this cycle, we saw preferences shift toward intermediate-term U.S. investment-grade credit, developed market financials and defense, and away from long-duration sovereigns, reflecting concern that aggressive fiscal support, elevated energy prices, and AI capex could keep yields under upward pressure. Looking ahead, the crucial signals will be upcoming U.S. labor and inflation releases, central bank meetings in June, further details on Treasury refunding, and of course the path of oil. Together, they will determine whether today's higher for longer repricing stabilizes into a soft landing narrative or tips toward a more disorderly adjustment in rates and risk assets. The picture today is one of powerful cross-currents. A fragile ceasefire and repeated attacks around the Strait of Hormuz are keeping oil prices and energy products tight, with Europe and parts of emerging markets most exposed to supply disruption and stagflation risk. At the same time, an AI-driven capex boom is pulling enormous capital into data centers and infrastructure, supporting U.S. growth, but adding to near-term inflation pressure just as bond markets digest multi-decade high yields and heavier issuance. How central banks navigate this mix of energy shock, technology investment, and already restrictive policy will be critical for the next phase of returns across equities, credit, FX, and duration. Watch shipping security, fuel inventories, AI capex guidance, and the next round of labor and inflation data for early clues. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.